Exit strategies. Subject to existing financing. Objectives. These are the objectives of this chapter. Learn to successfully acquire properties by taking over existing loan payments. Know how to minimize exposure by identifying pitfalls, and mitigate the risks inherent in this type of transaction. Transaction description. Buying, subject to existing financing, is the purchase of a property by taking over a senior loan's payments. The senior loan must be reinstated. The senior loan remains in the seller's name. The junior liens are discounted and released. This is a great strategy for holding property. Transaction keys. The keys to this transaction are working with the creditors, knowing the alternatives, and understanding the risks. Advantages. The advantages are evident. Increased acquisition leverage by assuming payments of an existing senior loan, and the senior loan remains in the seller's name. Disadvantages. The main disadvantages are that it requires cash for settling junior creditors, and there are plenty of risks. Another big disadvantage is that, although it may be years, in reality, the transaction truly does not complete until the existing loan is paid in full. That is when the seller's name will finally be disassociated with the property. Risks. The risks are clear. Money will be at risk. The senior loan must be reinstated. The junior liens must be either settled or bought. Seller may file bankruptcy at an inconvenient moment. Most loans are not assumable. The creditor may call the loan. Risk mitigation. The risks of this type of transaction can't be eliminated, but they can be mitigated. Remember, the more money you spend in a transaction, the less leverage you have. Spend only when there is certainty. One of the best ways to avoid the effects of a possible seller bankruptcy is to become the owner by having the property deeded. Do this prior to any spending. To be effective dealing with non-assumable loans, you need to have the right expectations. Understanding non-assumable loans. Non-assumable loans are designed such that, through the entire life of the loan, the original borrower remains obligated to perform payment. The original borrower cannot be changed. These loans have a due-on-sale clause. The creditor has the option to accelerate the loan by demanding payment of the entire present loan balance upon the sale of the collateral. The entire loan balance is due on sale. To call the loan due or simply call the loan means to demand entire loan balance payment. Non-assumable loan risks. These are the risks when dealing with non-assumable loans. Non-assumable loans cannot be assumed. Taking over payments does not imply assuming the loan. Creditors are great at taking money. They accept payment and then ask questions. Nothing, even the acceptance of a reinstatement payment from someone other than the borrower, nullifies the due-on-sale clause. Even after years, a non-assumable loan can be called due at any time. Called loan possibilities. These are the chances of the creditor calling the loan. Creditors like performing loans. Very few loans are called due. Generally, even when threatening to call a loan, a creditor will try to keep receiving payments. Usually it takes a long time for a creditor calling a loan to stop taking payments. The only options for a called loan are full payoff or foreclosure. Mitigating non-assumable loan risks. The non-assumable loan risks cannot be eliminated but can be mitigated. The best is to have enough equity to be able to quickly refinance or sell. Do not overinvest in the property. Have options. Closing options. There are two ways to close this kind of transaction: with the use of an escrow service and without the use of an escrow service. Use of escrow service advantages. The main advantages of closing using an escrow service are that it is safer, all recordings are professionally executed, and title insurance is available at closing. Maybe the best benefit is the closing ceremony. To the seller, it feels more official. Sellers take these closings seriously. Use of escrow service disadvantages. The main disadvantage of closing with an escrow service is that not all escrow services are open to it. Have an escrow service willing to do this prior to offering this closing. Without use of escrow service advantages. The main advantage of closing without an escrow service is that it is a much quicker closing. In fact, the majority of these types of transactions are closed without using an escrow service. Without use of escrow service disadvantages. The main disadvantage of closing without using an escrow service is capital risk. Usually, all goes well. However, consider the fact that funds are directly sent to a lender that is collecting on a debt. If something goes wrong, that money may not be returned. There is no official closing ceremony. The seller may not take the closing seriously. Closing subject to existing financing by using an escrow service. The escrow service will use a HUD-1. Line 503 is a provision for loan assumption. The value of the reinstated loan goes here. This is how the transaction works. The seller is a homeowner. The buyer is an investor. Regular homeowners don't buy this way. For this, the escrow service needs to be open to more complex transactions. Through escrow, the seller grants title to the investor. Through escrow, the investor obtains title and title insurance. Through escrow, the investor funds the first mortgage reinstatement and the second mortgage settlement. For this kind of transaction to work, there has to be a first mortgage and a second mortgage. This is difficult to do with more creditors. The first mortgage needs to be the one for closing. Through escrow, the first mortgage is reinstated and the foreclosure is rescinded. This resolves the foreclosure problem. Through escrow, the second mortgage is settled as per the settlement letter. The security interest in the property is released. There is no longer a second mortgage. The agent commission gets paid from escrow. Closing subject to existing financing without using an escrow service. The seller is a homeowner. The buyer is an investor. Regular homeowners don't buy this way either. For this kind of transaction to work, there has to be a first mortgage and a second mortgage. The first mortgage needs to be the one for closing. This is difficult to do with more creditors. The seller directly deeds the property to the buyer. Now the investor becomes the owner. After becoming the owner, the investor pays off the second mortgage. The creditor releases its security interest in the property. Also, after becoming the owner, the investor reinstates the first mortgage. Then the first mortgage rescinds the foreclosure. Now the investor owns the property and the foreclosure is resolved. Review. Buying subject to existing financing is buying by keeping the existing financing in place. Few loans are assumable. The vast majority of loans are non-assumable. Non-assumable loans can't be assumed. The buyer takes over payments. This kind of transaction provides great leverage, but also plenty of risks. The risks must be mitigated.